Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Kate Campbell, welcome to this episode of the Australian Finance Podcast.
It is wonderful to be back, Owen, to catch everyone up on what has been happening in the markets over the past month.
Yeah, it seems so strange when we say the markets. It's almost, I don't know, if it wasn't finance, the markets, like you're getting like a pulse check on what's happening on the markets. It's always a bit of a funny phrase, but that's what we're here to do. We like to do this every month, and we give folks an update on kind of like what matters that month. We blend that with one kind of educational piece at the start. Then we'll go into how your portfolio may have performed, and then just some key takeaways that you can kind of just use to filter out the noise, because there's so much noise in finance. It's like everyone's got an opinion. There's so many things happening. Hopefully this segment every month of the podcast is a way for folks to be like, okay, I got the big picture. Everything seems to make sense. Continue on.
Yeah, and if you want to keep the conversation going afterwards, we have a fantastic new and free Rask community. So it's a little better than Reddit because everyone has to sign up and have an account and they can comment. And there have been a few discussions on core and satellite portfolios, which got me thinking that this month our educational lesson should be about your core and satellite approach to investing.
Yeah, and you did actually put this to the community. And when I say community, I don't mean the actual community you just referenced. There's a whole part of the website for that. But I mean like the social community. And you asked them a few questions, which kind of brought up some interesting data around a core and a satellite approach.
Yeah, I wanted to know what our Instagram community were thinking about when it came to core and satellite. So the first question I asked was whether people knew about the core and satellite approach. Mm-hmm. So 68% said yes. So they've probably been listening to the finance podcast because we do mention it quite a bit. 14% said kind of, and 18% said not yet. So this episode is perfect for those groups because we're going to explain what the core and satellite approach is and how Owen views it, because everyone has their own perspective on different investing approaches.
Yes, they do indeed. And what investments do you put in your core, Kate, is a question that you asked. So for those people that do think about their core or just even know about it, what did they have to say?
Well, there was quite a few people that just said ETFs, which
yes,
you got us there.
Yeah.
Someone said a long-term index, dollar cost averaged, reputable and good long-term track record investments. So, okay. I mean, that pretty much covers. Yeah,
there was another one that said safe, reliable, boring. Love that answer. A lot of ETFs like VDHG, VTS, VAS, VDHD again.
DHHF, IVV.
STW, IWLD. A lot of the ETFs that, people would think are pretty safe and some would say boring.
Yeah.
But boring is good. Okay. And the other question you asked is, okay, well, that's the core, that's the center. What about the satellite? What investments do people put in their satellite, Kate?
Well, someone said for interest and fun speculations. Mm-hmm. Someone said ACDC, which I think we've mentioned on the show before. Mm-hmm. Riskier investments, thematic ETFs like HGEN, HACK came up. Mm-hmm. Small amount of money for things I find interesting, like biomedical companies. Mm-hmm. Some said individual shares that I am interested in. We had FANG come up.
Mm-hmm. NDQ, which is the NASDAQ 100, which we'll reference in a moment.
Yeah, FMG. So Fortescue.
Yep. Someone did say Maya. Now, I'm assuming they mean Maya shares. They don't put the actual store in their satellite approach, but Maya is an actual company. So,
and it's listed on the ASX.
Yeah, so why not?
Someone said 5 to 7 individual stocks carefully selected to ensure no overlap with my core.
Okay, like it. And finally, you asked the question of what other questions do you have about the core and satellite approach? And there are some good responses here, which we can get to.
Yeah, so there was a few questions around the likes of if you have an investment like VDHG or DHHF, which advertise themselves as the one ETF to rule them all. Do you actually need a satellite part of your portfolio? One of the questions was what should be the ratio between core and satellite? And I think that's something that does depend on individual preferences and risk profiles, but we can chat about that more. How big should the core portfolio be before you start thinking about a satellite? So is that something we do once we hit $100,000 in our core? Or is it something we can start thinking about earlier on? When's the right time to sell? Which is the question that no one really has an answer to.
Yes, that's the hard part. The easy one is buying. Everyone likes to talk about buying. Not many people talk about when to sell, or even what to sell. So there were a lot of good questions here, and I think maybe just quickly, just to define what we mean by core and satellite approach. So the core and the satellite is this idea that you have the core of your portfolio, or even the core of your wealth, depending on how you define it, in kind of reliable, boring, low-cost things. If your friend or your brother-in-law has ever come up to you at a barbecue and said, "Hey, I've got this really good idea. It's called dot dot dot," whatever that is, I can almost guarantee that is not a core investment. That is something that you would have a very small percentage of your money in, the satellite. The satellite can be viewed as in it's a higher risk. Maybe the future is less certain, even though your brother-in-law will probably tell you how great it is and how it's much of a guarantee it is. All that stuff goes in the satellite. If you're in doubt, chuck it in the satellite. Those are smaller positions. They don't necessarily have to be the bottom drawer type stuff. And they're probably the things that, based on empirical data, actual data from history, are not as reliable. In your core, they're the boring, low-cost, reliable things, as people have mentioned. So that might be things like diversified ETFs, as in ETFs that have a lot of individual shares inside them. They're low cost. It could be things like blue chip shares, if you're that way inclined. It could be listed investment companies that are established. It could be your property. If you take a whole of wealth approach, it could be your home. That could be a really core part of your wealth creation. That is a core investment. An investment property, however, would be a satellite position, in my opinion, because that's kind of you taking more risk. So that's how you kind of define the core and the satellite, which is really important to understand. And we can definitely answer all of these approaches. But before we get to that, Kate, I thought I'd throw back to you for one question is, do you in any way, a roundabout way or a direct way, use a core and a satellite approach?
I think I've fallen into it because most of my investments are low-cost diversified ETFs. I have about 5 or 6 of them, and they form the bulk of my net worth. Also, the money I had to put into purchase of properties. So that's just cash sitting in the portfolio, basically. And my superannuation, which is a diversified portfolio.
Yeah, that's a good point. Superannuation, where does that sit? And the answer is it probably sits in your core, but a lot of people kind of like think of that as separate money. Because you can't touch it until you retire, say until after 45, a lot of people don't actively start thinking, well, hey, that's my money, I can use it soon. But once you get 45, 50, 55, 60, in somewhere in that range, you typically start to see your superannuation as an active part of what you can do with your money. And at that point, you would consider that your core. There are many similarities between what super should do for you and what a core portfolio should do for you. Let me give you an example. Most of the reason that we use superannuation for retirement planning is because it's a lower taxed environment. And so what that means is you want to maximize the advantages of that. So you pick investments in your super fund that are, by their nature, lower tax. They might get franking credits, and there's not a lot of active trading. One of the problems that I've seen in the last 5 to 10 years is people opening up self-managed super funds or getting very heavy-handed with their super fund. They're constantly buying, they're constantly selling, think that they know what they're doing, and they don't. So for my superannuation fund, just for full disclosure, I just use an indexed option. So it's an index option because I'm
through an industry super fund.
Yes, because I'm in my early 30s, I can disclose that. I've probably got 30 years, 35, 40, who knows, 50 years by the time they change the rules 10 times until I can access that money. So for me, what I want to do is I want to pick an investment that's probably going to be here in 30, 40, 50 years and will not have a lot of tax consequences between now and then because, as Charlie Munger said, compounding is very, very powerful, don't interrupt it. And the idea is that tax and fees interrupt compounding, especially tax. And tax is caused when you buy and sell. So particularly when you sell. So with your super fund, that's always a core position, but you can treat that separately if you're a bit younger and you want to kind of like let that go in the background, but then treat this money outside of super as its own core and satellite approach. Does that make sense?
Yeah, I think that's probably the easiest way for most people to think about it.
Yeah.
And keep things separate.
Yeah. It's actually interesting today. Mitchell is sick, and Mitchell normally does all of the calls for our Rask Invest service. So where we can say this in this podcast, we're 1 month in to the initial investors investing with us. And that's great because it's been a really good month. We've learned a lot. The community's been amazing. But he's sick today. And as it so happens today, the 2 calls that I've got with the investors, because I'm standing in for Mitchell, both have self-managed superannuation funds and both have told us that they want to invest their core portfolio with Rask. So they're both at later stages of their life and have bigger balances where they're thinking, I want to align my super with what I've been doing outside of super for a very long time. And that is simplified versions of their portfolio, ETFs in the core, and kind of get rid of the satellites and just have like the ones that they really are keen on and just get some clarity on what they're doing. And so that's a good illustration of how people, when they get to that point, they go, you know what, it's time to take this a bit seriously. I'm going to do a core and a satellite. They've fallen into it as well. And I think that's just natural for most people.
Yeah, it's interesting because I wouldn't have any satellites per se in my superannuation, but I have satellite positions outside of superannuation, which I've slowly been trimming back over the years as I've tried to make my life more simple because I did the fun stuff, I did the learning, and now I have a lot of other things I want to do with my life. So I want my investments to be as simple and as consolidated as possible.
I think if you look at the Pearler platform, and full disclosure, Pearler is a long-term sponsor of the podcast, that's the best illustration of where the industry is going. See, Pearler is one of the only brokers that doesn't force you just to pick ETFs, and they don't charge you more to pick shares. So some of the new platforms are charging you more in brokerage fees to go and buy shares versus ETFs. It's kind of like they're forcing you to pick ETFs. Now, we know as a community at Rask that ETFs make the most sense for the most people. So that's fair enough. But even though Pearler allows you to buy international shares or Aussie shares directly, 87% of the money is invested in ETFs. And if you go back to that question that we had about a core and a satellite approach, I think that's the best indication of what people are doing, because most people that use the Pearler platform are Pearler's only a few years old itself, but it's grown really fast. And the people that are using it are people that are thinking about the future, because those people have had a chance to switch to Pearler, obviously, or unless they're new investors. And as a result, they've gone, how can I just clean this up? How can I make it simpler for me? And I think that's the best indication of where we're going to go as an industry, is probably 80 to 90% of people's money will be invested in ETFs, which, by the way, don't have to be index fund ETFs. They can be active ETFs. And then you'll have the shares around the outside. You'll have your crazy ideas like your cryptocurrencies and all that sort of nonsense. And then you'll have other things around the outside. And I think that's probably where we're going to go. And that kind of answers a few questions about how much, do people typically have? Well, there's the data that suggests that. And I think if you are going to start, you start with the core and then you build outwards, because you get familiar with investing in a more safe way. And then you move into the satellites and that type of a thing.
Yeah.
Whereas
it's interesting because
you and I started the other way.
Yes.
We started from the outside in.
I definitely started with individual shares and $500 in a brokerage account at 18. Did a bit of mucking around. I think a lot of people probably still start that way and then start to learn about investing and then maybe discover the podcast and then go, okay, ETFs are a thing. I can build a core portfolio. So it's interesting. There's probably like two groups of investors. One group that start with the satellite not knowing and then start building their core, and then the other group that really start with the solid core, and a few years on to their journey, they go, okay, I'm ready to add maybe a thematic ETF because I'm really interested in cybersecurity, or I want to add this individual share because I've done a lot of research and I'd like to try investing in individual companies.
Yeah, one of the things that's really interesting, Kate, I think you know this, is I kind of quit social media about a month ago, 3 weeks ago, and my life is at least 20% better, I must say. Like my headspace is at least 20% better. And I didn't realize the hold that like X or Twitter had over me. But I
You were quite addicted to Twitter.
Yeah. You could get the weekly wrap of like where you spent your time on your phone and all that sort of crap. And there was a lot of social media apps, but only really X, because I got onto X really early, or Twitter, because I wanted to engage with investors. But so it's just been bombarded with crazy news and just horrible videos and it
isn't a high quality social media anymore.
Yeah, well, yeah, and it's just like this vortex thing. It's just gross. Anyway, I'm off that, because one of the things that really nudged me in the end, I was like, that's it. This is enough. I was publishing content about ETFs and I was giving like deep dives and like showing people like how you can use an ETF. And a lot of people would respond with like, that's not investing. Investing is ... like buying shares, buying this, buying that. And this comes back to your point about most people start with shares, because shares a shiny object syndrome. They seem more interesting, more intellectually stimulating, more exciting. Whereas if you go with an ETF or you go with a core portfolio first, it doesn't seem as fun. And so that's why if you have kids, I don't think the best thing to do is buy them an ETF and only an ETF, because they won't grasp the excitement. They won't grasp the pleasure of what it means. Go and buy them Nike shares. Go and buy them Apple shares. Go and buy them, insert Australian company, Woolworths, something that they can understand, and they will get more excited about it. But for the rest of us, there's no time like the present to build that core. And so I would say go and think about this idea of a core and a satellite. And in the interest of time, I know we want to get to the market update. I will give you, in the history of Rask podcasts, no one has ever read from a script. But I'm just going to read a very brief snippet from our upcoming owner's manual, which is like a document that I put together for anyone that invests with us. An owner's manual is something that Warren Buffett championed decades ago with Berkshire Hathaway. And basically it's our way of saying, this is what we're doing, this is how we're investing, and if you don't like it, it's not for you. And I think that's really important to understand, that everyone should read this document before they invest with us, because if you don't understand what we're doing, you shouldn't be invested with us, period, shouldn't be invested in anything. But secondly, we don't necessarily want you to invest with us if you don't like the way we're invested. Don't just invest with us because. And so this document would take you through that. But there's a snippet in this that I just want to read really quickly. And it goes, through the Rask community over many years, we've championed the core and satellite approach to long-term investing. You can think of the core as what a financial planner would call the SAA, and the satellite as what a financial would call the tactical asset allocation. Using a core and satellite approach to long-term investing makes sense because it helps you invest sensibly in proven strategies within your core, but also scratch the itch of stock picking, high-risk assets, and so on within the satellite component of your portfolio. Though the exact figure is debatable, various literature shows us, and we believe, the majority of an investor's long-term return comes from his or her core portfolio, the low-cost, boring, diversified part, and not the security selection. Meaning, don't get hung up on which share or ETF to buy. Just buy well and stay invested. For all investors, the implications of this research should have been obvious by the mid-1990s. Spend more time getting your portfolio set up right with a clear growth versus defensive mix, and then simply focus your attention on consistently sticking to your plan. Vanguard's success is a clear example of this research in action, but it has taken 49 years for them to get this far. If we assume that, say, 90% of the return we will get comes from picking the core and staying invested, the logical next step is that we should do everything within our control to ensure that we stay invested through the good times and the bad. The problem is, as the Dalbar report has shown us for 30 years, most investors underperform their own stocks or funds because they are consistently switching in and out of investment products. And so I'll end it there because it's a long snippet. But basically, what this research has shown us for decades is that the single best thing any investor can do is just get invested and stay invested. Not switch around, chase the latest thing. But there are so many reasons why people don't just stay invested. And it's at the point now where if someone invests in like the VAS ETF, which is probably the single most boring ETF in Australian history, and it's also the biggest, which is just the top Australian shares. A lot of investors, well, definitely on average, but a lot of investors who are invested in that ETF, even though they probably know what it does, will not stay invested because at the top of the market, they'll freak out, they'll read some news headline, and at the bottom, they'll also be freaking out and they'll be thinking it's going to keep falling when they should have invested. That's why dollar cost averaging works. And so this Dalbar report, which has been going for over 30 years, shows that on average, the investors in the fund underperform the fund because of their behavior. And if you think about a core and a satellite approach, a core allows you to say, I'm going to be fully invested. It's going to be boring. I'm going to do it every month and I'm going to automate as much as possible. But then also, if you have that kind of monkey brain like I do, where you're like, oh, that looks cool. I'll go and invest in that thing for a little while. do that in your satellite, keep it segregated, do it somewhere else, do it in a brokerage platform, do whatever. Keep that separate. And that is the essence of the core and satellite approach. And that's why I believe it has worked and why I believe that over the next 10 years, everyone will be doing it. And they'll be prioritizing ETFs in the core.
We can put the rest of your write-up about what the core is and the components and how it works in the show notes for people to read as well.
Yeah, for sure. But we should probably get to, I guess, what's happened in April.
Yes. What has happened? I mean, the time just seems to keep
Well, when you're
passing me
studying
by.
like you are, things move fast. You don't have
a blink and the markets run away from me.
So basically what we can see, and I'll quickly run through this. We do this every month. So we can see, and I'm going to be referencing prices that may not be exactly correct. So because the way I'm referencing them is trying to get it so that it's how you would think about it as an individual investor here in Australia. But depending on how you cut it up, it could deviate slightly. And past performance is obviously no guarantee of future performance.
So we're looking at what happened in the month of April?
Month of April, because
Okay.
we have to wait for the data and then we do the episode. So in the month of April, we saw the NDQ ETF, that's the NASDAQ 100 from BetaShares, disclosure, sponsor of the podcast, fell 4%. The IVV ETF fell 3.6%. So the NASDAQ is just the NASDAQ 100, mostly tech stocks. The IVV ETF is 500 shares, like Nike and that sort of stuff would be in there. The VAS ETF, which is Australian shares, fell 2.9%. The FTSE, which is the UK stock market for anyone that follows that along at home, we use the F100 ETF to track that. That went up 2.2%. So for the first time in probably human history, the UK stock market did something positive. Hang Seng, which is, I've just got the index return, was positive, was around about 6%. The IAF ETF, which is an Australian bond ETF, fell 1.9%. The VBND ETF, which is a global bond ETF, fell 1.5%. A cash account from like ING, Macquarie, whatever, is paying about 5%. Still, that's pretty positive.
And that's per annum, though.
Yeah, per year. NUG, which is the Van Eck ETF, just to get some diversification of different providers in here. The NUG ETF, which is a gold ETF, rose about 4.6%. Importantly, I'm talking about the NUG ETF in Aussie dollars. So like it's in Australian dollars, like that's what you see. So you've benefited from the currency, which is important because the currency fell slightly. As someone who is about to go to Europe, I can tell you that I've been very disappointed that the Australian dollar has fallen. It's made my trip more expensive, and so be it. Bitcoin in Australian dollars fell 12%. So that was the month, and we can see that shares broadly fell. We can see that bonds broadly fell. We can see that gold kind of went up, and cash is pretty strong.
So if someone's looking at their long-term core portfolio, they may have noticed it fell in value during April.
Yeah, so I've got, and you can refer to the Rask Invest website, but say, for example, which one should I use? Say, for example, our balanced portfolio, that fell 1.6% at Rask Invest. So that's the one that's like 50-50. And that was just in the month of April. And the reason is, if you look across the portfolio, most people listening to this will have seen their super fund or their portfolio fall. And the reason is very, very, very simple. It started with the United States, and then here in Australia, there was a wave of expectation that suggested interest rates will not be cut this year. And it's got to the point now where the current thinking amongst investors is that interest rates will not fall in 2024. Some, we'll call them economists, if that's a real thing. Some economists have come out and said that interest rates may actually go up before they come down. So this is a very different reality to 3 months ago at the very beginning of the year when everyone thought interest rates would be cut this year. Some people thought they'll be cut last year, like Dr. Andrew Deremuth over on our Australian Investors podcast. He was very wrong, and they went up. So the reality is, Kate, that when interest rates go up, most investment things go down because you could just put your money in a bank account because your mortgage gets more expensive, you have less dollars to invest. It's pretty simple. Bonds typically fall when that happens. So do shares. There's two broad different reasons, but typically what we see in that scenario is your term deposit will start to offer more. Now you might be saying, well, hold on a second, Owen. Interest rates didn't actually go up, and here or in the United States. So what do you mean interest rates are going up? This is based on expectations, not based on actual interest rates. So typically you might have heard us say that like the stock market is forward looking. It looks towards the future, which makes sense because that's where we're going. So what is actually happening is investors as a collective are now thinking, they're hearing what the central banks are saying. They're hearing what the economic data is saying. They're saying, actually, looks like my mortgage could actually stay where it is for the next 12 months. And everyone collectively, you can actually get a pulse check on this, like mathematically. And you can see the expectations have gone up, meaning that if you look at like the interest rate expectations over time, 3 months ago, you would have seen it falling because they thought interest rates would begin to fall. No. And so that's why you've seen things fall, even though interest rates themselves haven't changed. Does that make sense? Kind of?
Kind of.
Kind of. But because if you buy a share today, you're getting the future return. A lot of people, when they think about finance, they go straight into it and they're like, oh, well, it did pretty good last year. The stock went up. Therefore, it's a good investment. That does not necessarily mean that the future is going to be the same. That's why you see all of those disclaimers that say past performance is not a reliable indicator of future performance, because future performance is based on many different things and it will never be an exact replica of the past. And so while it may rhyme, like good companies may keep on winning, like Apple may keep on going up because it's done well in the past, the reality is it's not going to be the same. 2025 will not be the same as 2024, will not be the same as 2023, even though they may look similar. So the reality is that what we're investing in is based on the future expected return. It would be like, if you go and buy an ETF today, you expect that it's going to grow in the future. You expect that it's going to pay you a dividend in the future. But if you expected that it wasn't, well, then obviously you'd be willing to pay less for it, which kind of makes sense. It's just that the jargon that we wrap around it doesn't make a lot of sense. So what does this mean for people? Is probably the natural question, Kate. It doesn't really, to be honest, it doesn't really mean that much for most people. For me, and the update that I gave to our investment committee, what it basically means, and for people approaching retirement, is it probably means that you want to be mindful that if inflation information does come through and it is really strong, the central banks will likely be forced to act and increase their actual interest rate. So your mortgage would actually go up, or the term deposit would actually go up.
Which I think everyone's enjoying a bit of a reprieve on their variable rates going up every month.
Yeah. I mean, we've all got opinions. We've all got crystal balls. We're all the armchair coaches of the economic world. I think from where I sit and the things that I'm seeing, I actually think that it would be quite devastating if they increase interest rates. So one economist, who I won't name, suggested interest rates could go up 3 times. So it'd be like 0.25, 0.25, 0.25. Now, that's really good because it gets some good headlines. I don't actually think that's going to happen. Because the reality is, I don't know if you've been out there and spoken to people aren't like coping very well financially. Like, sure, there's some demographic, which is typically the older demographic, that have the biggest super balances and that sort of that thing, and well done. They're relishing. It's their time in the sun. Let's go and spend some money. So that's what we're seeing from that cohort. But in the rest of the cohort, people with mortgages, people with kids,
people who haven't had a wage increase for a year or two,
they're really, really feeling it. And this is the problem that we're having, is that the government is wanting to stimulate the economy when the central bank, who does the interest rates, only has one tool: interest rates up or down. Like, there's only one thing that they can do. And so if the government's out there saying, yeah, we'll do this, we'll do this, we'll do this, what is the central bank going to do? They're going to be like, well, we've only got one thing that we can control over here, and that is our interest rates, and we'll probably have to go up if they keep doing this. And there's a whole reason why that, this is in play. We've got high immigration, we've got very, very low unemployment. That's probably the number one thing. But then if you look at like retail sales or what people are spending at the shop, that's struggling. So it's kind of a tale of two economies. Now, what does this all mean? I don't want to keep ranting, but what does it all mean? It basically means that your core portfolio can basically stay as it is. However, if you are towards retirement and you're thinking about income and that sort of stuff, keep that cash buffer. Everyone should keep the cash buffer because you're going to get a good interest rate. Make the most of your term deposits, review them.
Check you're in a high interest savings account.
Yeah, review if your broker is actually paying you any interest. Another thing is I won't take too long, but there's a space between government bonds and shares. There's like this middle ground, which is where you can tilt your portfolio to income without taking all the risk of shares or all the risk of bonds, and that's called credit. And there are some ETFs on the market that do that, and so that's what I'm actively looking at. And that is a wrap for this month. It's been a tough month for a lot of investors, but stay with it because, we could be through the worst of inflation and all that sort of thing. But just keep mindful of it.
Yeah. And even if you can't invest as much each month, see if there's a way you can keep that habit going, even if it's just reducing the amount you invest. Try and keep that automation moving, even if you have to adjust it.
Yeah, that's it. And over the next month, you'll be hearing more from us about Rask Invest, which is our new investment service. So you can learn more by following the link in your show notes. You can also book in a half an hour call. It's just totally free. You can explore the PDS, product disclosure statement, and target market determination. We have officially opened, and we are now opening beyond just the initial cohort, but you'll hear more about that in the next few weeks. So if you want to start building your core portfolio, or if you want us to do it for you and guide you through that process effectively, you can learn more about Rask Invest by going to the link in your show notes. There is also some fantastic resources there for anyone who wants to connect with a financial planner. We have a way to do that. Otherwise, you can head to moneysmart.gov.au. And obviously, if you're struggling with debt, if this idea of interest rates going up freaked you out a bit, you're not alone. Jump into the community, talk to us, but also reach out to money counselors or reach out to financial counselors, money coaches. And you can find all different types of resources by going to the National Debt Helpline as well. There's one for business as well, just for people that aren't aware. Kate, there's been a lot to go on. We've got some resources in the show notes if people want to keep snowballing their knowledge. Heaps of information there. Thanks for joining me.
Thanks for listening, everyone.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.